Warren Buffett, the world's most famous investor, famously described financial derivatives as weapons of mass destruction. And yet derivatives such as options, futures and swaps are used by many fund managers looking after your pension and ISA investments. So what are derivatives and why do they provoke such a range of opinions? At their most basic, derivatives are contracts in which two parties agree to make a trade within a certain time frame and within a certain price. They're called derivatives because they are derived from the underlying market, whether that be commodities such as pork bellies, assets such as shares, bonds and currencies, or the future direction of interest rates. There are two types. There are derivatives like options that give their holders the right, but not the obligation, to make a trade. By contrast, other derivatives like futures lock in their holders and oblige them to make the trade. Many derivatives are bought on public exchanges such as Euronext in London and the CME Group in Chicago. However, the vast majority of derivatives are bought privately over the counter between sophisticated investors such as investment banks and hedge funds. The size of the derivatives market is mind-boggling. Earlier this year, there was an estimated $693 trillion, that's 430 trillion pounds, of outstanding derivatives contracts that had been traded over the counter. The size of the market has alarmed many people like Warren Buffett. They think the ability to buy a derivative with a smaller amount of money than it would take to actually buy the underlying asset fuels enormous speculative activity. Combine this with the bewildering complexity of some derivatives and you get to a point, as we did in the financial crisis, where institutions no longer know how much of a risk they've taken on. The crisis was sparked in the US, where derivatives linked to mortgages held by people who couldn't afford them slumped in value, exposing banks to huge losses. But there is another, much less sinister side to derivatives. Derivatives are also used by fund managers as a form of insurance to protect investors. Derivatives also help fund managers be more efficient. They can use them to change their positions quickly and at a lower cost than if they actually had to buy and sell stocks and shares. Let's look at the insurance protection derivatives offer, as it's topical right now. After the stock market rally we've seen in 2013, some funds have bought put options to lock in some of the gains. A put option gives the holder the right to sell an investment at a set strike price in the future. For example, the FTSE 100 has advanced 13% so far in 2013. It currently trades just under 6,700, close to its all-time high. Investors are happy about this, but may be concerned how stock markets react when the US Federal Reserve starts to reduce the amount of stimulus it injects into the world's largest economy every month. On the one hand, the Fed easing back on its support is a good sign that things are getting better in the US economy. However, it could unsettle markets. Fears of a Fed taper caused the FTSE to tumble in the early summer. If I'm worried about this happening again, I could buy a put with a strike price below the FTSE's current level. If the FTSE falls below the strike price, the value of the put will increase, offsetting the loss in my investments. If the FTSE continues to rise, then my put will expire worthless, but my investments will have risen in value. In that case, the money I've spent on the option has been wasted. However, as with insurance, I've had the benefit of knowing I would have been covered had there been an accident. The other type of option is called a call. This gives the holder the right to buy an investment at a strike price in the future. If the FTSE rises above the strike price, I get the benefit of buying the index at a cheap price. If it stays below the strike price, the option expires worthless. Some fund managers sell call options to other investors. They use the money or premium they receive to boost the income their fund generates for their investors. So you can see, derivatives are complex and need to be carefully managed, but in the right hands, they do bring benefits.